Good afternoon. Welcome to EduSet Network. Friend, as you know, this week we have organized a lecture on economics, and today we will begin with the capital flow and the impossible trinity. And what is all about this? We will discuss with our renowned expert who is sitting in the studio, Dr. Abhijit Sen Gupta. He is associate professor at Center for International Trade and Development in JNU, and he has done a lot of work in this area. So I hope his knowledge and experience will help us to understand the subject in a better perspective and also to form the opinion in this regard. So on your behalf, without taking much time, I just request Dr. Sen Gupta for the EduSet lecture. Welcome, sir.
Thank you very much, Mr. Kumar, for those very kind words. It's a privilege being at this center and delivering this lecture. So what I thought I will talk about is capital flows and the impossible trinity. If you bear with me for some time, in a minute I will tell you what this impossible trinity is all about, for those of you who are not familiar with the term. This is the brief outline that I propose to follow in this lecture. So I'll start with introduction and motivation as to why this topic is important. I'll then talk about India's experience toward liberalization of capital flows, and these have been very different across different types of capital flows. So I'll talk about what it has done in respect to foreign direct investment, what it has done with respect to portfolio investment, and also what it has done with respect to some debt flows. And then I'll compare India with some of the other countries, similar emerging market countries, and see that how India comes out in that kind of a comparison. And then I'll try and talk more about the impossible trinity, what it exactly means, how does one quantify this impossible trinity, and what has been the Indian experience. I'll also talk about the different policy choices that India has undertaken in this impossible trinity and how it has affected our performance before concluding. So as most of you must be aware that over the past 2.5 years, the global economy was completely shaken by this crisis that followed after the collapse of the Lehman Brothers. Now, one of the main impact of such a crisis was that it led to a sharp disruption of capital flows across different countries and especially across some emerging markets. So, if you look at the global capital flows to emerging markets, you can see that there was a sharp dip in 2008, which continued in 2009. But subsequently, one is expecting these capital flows to revive. So from 594 billion, external financing in 2008 is set to increase to about 833 billion this year. That's a sharp increase. So what happens is that when countries face these kinds of disturbing or disrupting capital flows with such variations, then there are a lot of questions about what is the impact of such capital flows on the overall economy. And this has rekindled the debate on whether we should start again imposing controls on these kinds of capitals. So the question is then, why does a country want to impose restrictions on capital flows? And this can be because of primarily two reasons. Firstly, what we have seen is that if you allow capital to come into your country in an unbridled way, you don't put any kind of restrictions, then this leads to a number of disruptions in the economy. For example, it can exacerbate some of the financial fragilities. It can lead to asset market booms. It can lead to credit booms or over credit in the economy. And this can then lead to a crisis when there is a sharp reversal of these kind of flows. The second is that it creates a number of difficulties in macroeconomic management, what is traditionally known as the impossible trinity. And I'll again define this term in a little bit as to what exactly does this mean. So as a result, to counter this issue, a number of countries in recent past have also resorted to imposition of capital controls, be it Brazil, Taiwan, Russia, China, so on and so forth. Now, India has been very fortunate because of the proactive policy making that has existed in this country, that its approach towards capital account liberalization was not sudden. It can be termed as being calibrated, gradualist. So there was a very thought out approach as to how India should liberalize the capital flows. So if one looks at the extent of capital flows liberalization in the country, one finds that this has been done in a very principled way. For example, there was a principle that there should be a shift away from debt to non-debt creating flows. We should not depend too much on debt flows, and we should depend on FDI, portfolio investment. External commercial borrowings, which is a very important source of capital for a number of developing countries, has not been resorted to that much in the Indian context because there are a lot of restrictions on these kind of flows. Volatile flows, even if they are from non-resident Indians, have been dissuaded. We only want stable flows. That has been the guiding principle. And finally, in the recent years, we have seen that as more and more stable flows have started coming into the countries, there has been a gradual liberalization on outflow. So if one looks at India's capital account liberalization and focuses on different kinds of flows, one finds that the policy of FDI as it stands today has been significantly liberalized over the last 2 decades. Currently, there are only very few sectors which do not attract FDI. Otherwise, FDI is universally allowed. So if you have some sectors like atomic energy or some sensitive sectors, those are the sectors which are barred from getting FDI. Some of the less sensitive sectors, but though they have some importance for the Indian economy, are allowed for FDI, but then they have sectoral caps. And these would be things like the banking sector, insurance sector. But again, talks have been going on increasing the FDI limit for these sectors. As a result of this, we find that there has been a sharp increase in FDI inflows into the country. They went up from being just 4.5 billion in 2003-4 to being about 38 billion in 2009-10. And this has also got reflected in India's share amongst emerging markets as a destination for capital flow increasing sharply. Now, in recent years, as I said, that there has also been a sharp increase in outflow of FDI. And this has happened primarily through the way that Indian companies have taken over some of the big multinational companies in other countries. So again, even in the case of outflow, India has adopted a gradual approach. So the upper limit on FDI outflow has only been liberalized in a progressive manner. India has been relatively more strict or restrictive when it comes to portfolios, but nevertheless, portfolio inflows have also increased sharply over the last few years. They reached their peak prior to the collapse of the Lehman Brothers in 2008. Now, in terms of some of the additional restrictions that are put on portfolio investment, which were not there on FDI, for example, only certain qualified institutional investors can only invest in the stock market, and these are foreign institutional investors who are registered with the Securities and Exchange Board of India. But they are also subject to several caps. So, for example, there are separate investment caps on sub-account of FIIs, individual FIIs, and aggregate FII investment in a company. Non-resident Indians are also allowed to invest in the stock market, or they can undertake portfolio investment, but again, they are also subject to several risks. Outward portfolio investment has also again been liberalized in recent years, but this has also happened in a very incremental manner. So, not in a very drastic manner. India has been most restrictive in terms of liberalizing debt flows, and that has a reason because it learned from the experience of what happened to Latin America in the 1980s or some East Asian countries, where these countries faced a debt crisis. So external commercial borrowings are subject to a number of risks. They are subject to either they have to satisfy eligibility criteria. There is cap on borrowers per financial year. There is a minimum maturity period. There is a cap on all-in cost ceiling. So they're restricted by a number of criteria. Outflow on ECB is also again subject to a number of restrictions. There being limits on the amount that can be prepaid within a particular year. But despite these restrictions, again, ECBs have increased sharply in India over the last few years, and especially prior to the period to the global financial crisis. And this is primarily because that in India, the interest rates that are prevailing are significantly higher than the interest rates in some of the developed countries. Some of the other restrictions that are imposed on other kinds of debt flows apart from ECBs include things like foreign investment in government securities are heavily regulated by way of caps and limits, and they are also subject to only being allowed, only NRIs and FIIs can only invest in these kind of flows. So as a result, what has happened is because of this cautious and gradualist approach, India's extent of liberalization has been significantly low compared to some of the emerging market countries. So there are two ways to look at the extent of capital account liberalization. One is you look at the existing laws and regulations that govern capital flows. So if that is the case, then when a country liberalizes some regulation, then one can say that that country has undertaken greater capital account liberalization. This is what is called primarily a de jure measure. In contrast, what you have is a de facto measure which looks at the absolute volume of capital flows. And these two measures can be very different from each other. For example, a country might have a high de jure level of capital account liberalization. That is, the capital account, there is no limit on capital moving in or out of the country. But because of some factors, they can be political, they can be economic, capital doesn't want to move into that country or out of that country. On the other hand, you might have a country which is a very low level of de jure liberalization, that is, the laws are very strict, but somehow the capital finds a way to circumvent these laws and there is movement of capital out of the country. So that kind of a country would then score very low on de jure measure of capital account liberalization, but very high on de facto measure of capital account liberalization. So if you look at the de jure measure, again, here there are four graphs, and what one witnesses is that India has been marked in blue. What one witnesses is that India has moved from being on somewhere in the middle of the spectrum to being towards the right or towards the lower end of the spectrum. The scale is measured from -2 to +3, and a higher number indicates greater liberalization of capital flows. It's evident that over the past 3 decades, 1970s, 80s, 90s and 2000s, countries have significantly increased their extent of capital account liberalization. And this has happened because you see the upward shift of the median line. But it's clear that India has not kept pace with this kind of a liberalization. In contrast, if you look at the de facto measure of liberalization, again the story is very much similar. India has been marked in blue, and again you can see that India has always been on the restrictive end of the spectrum. Only a very few number of countries like Iran or something like that are more restrictive than India. Even a country like China, which till 1980s and 1990s had a lower amount of capital account openness than India, has significantly moved ahead of India in some of the recent years. So now, what is impossible trinity? I mean, impossible trinity basically is a concept in international finance which tells you that if there are three objectives: to have monetary independence, that is, you are free to set the interest rates that you want you want to have for the betterment of your economy. Secondly, if there is a fixed exchange rate regime and there is full capital account openness, that is, capital is allowed to come in and out of the country, at any given point in time, you can only attain two of these three objectives. You cannot simultaneously attain all the three objectives. For example, think of a country which is a fixed exchange rate regime, right? The exchange rate is not moving, and it allows capital to flow in or out of the country without any restrictions. Then by definition, that country cannot have an independent monetary policy, because it has to set its interest rate with what is the global interest rate. Because if interest rate was lower than the global interest rate, you will have all the capital moving out of your country into the other country. So it loses monetary independence. On the other hand, the only way a country can maintain monetary independence as well as a fixed exchange rate, that is, the only way it can set its interest rate as being very different from another country, but continue to have a fixed exchange rate with it, is only if there is complete blockade of capital account. That is, you don't allow capital to come in or move out of the country. So that's precisely what the impossible trinity is, that at any point in time, out of the three desirable objectives of having a stable exchange rate, independent monetary policy and an open capital account, you can only achieve two and not all the three. So it's impossible to have this trinity. Now, India, as some of the other countries, has again is a desire to meet some of these objectives partially or fully. For example, we all know that India runs a current account deficit, and this deficit needs financing. The only way to finance this is through capital flows. So therefore, capital flows aid growth by providing external capital to allow us to sustain an excess of capital over excess of investment, over savings. So we desire to have an open capital account to some extent. Secondly, we also want an exchange rate which is stable and competitive. We don't want large variations in exchange rate from day to day, because this disrupts our exports. And a large part of Indian exports is labor intensive, as a result of which a reduction in exports has direct implications on employment potential of the country. Finally, we all want to have an independent monetary policy because we would like the government to be armed with this tool to deal with either domestic or foreign shocks so that it can set interest rates which are very different from the rest of the world. So as a result, again, as I said, India wants to have all these three to a certain extent, but again, as the theory says, that you cannot have all of them together. So the way we try and do this is we try, most of the discussion on India relating to these three objectives have been very rhetorical and has been just words. So what we try and do here, and which is what I want to discuss about, is we try and quantify the various aspects of impossible trinity. That is, what is the extent of monetary independence in India? What is the extent of exchange rate stability in India? What is the extent of capital account openness in India? And how India has managed to move across this impossible trinity. So monetary independence is measured very simply. It's the inverse of the annual correlation of the monthly interest rates between India and the United States. We take United States as a base country because that is the country which is closest to us in terms of capital flows. There is a lot of capital flowing in and out of that country. And also it's a benchmark for global interest rates because globally interest rates of most of the countries are influenced by what is happening to the US interest rates. So while mathematically this is the symbol, what it basically means is that higher is the correlation between Indian interest rates and US interest rates, closer is the second term on the right hand side equal to 0. So if correlation between I and I star is 1, then you have that entire term going to 0. 1 minus 0 is you have the entire term going to 1. Correlation of I and I star is 1, then that term is 1, so 1 minus 1 is 0. So basically it means that if your interest rates are very correlated or highly correlated with the United States interest rate, you're basically following what the United States is doing, then you have no monetary independence. Your monetary independence is close to 0. Whereas if they are not at all correlated, then I and I star correlation would be close to minus 1. And if that is the case, then the way it is constructed, MI should be equal to 1. Now, exchange rate stability or ERS is calculated using the annual standard deviation of monthly exchange rate between India and the United States. Again, we look at the standard deviation, and the standard deviation is in the denominator. So basically what it means is that higher is the standard deviation, lower is exchange rate stability. So higher is the variation of exchange rate stability within a year, lower is this ERS value. So again, by construction, this takes a value between 0 and 1. Now, for capital flows, we take a slightly different measure from what has been done in the literature. In the literature, especially the key paper by Eisenman and his co-authors, is that capital account openness is measured according to the de jure measure. But we find that there is some problem with it. I mean, as I discussed before, that a country can have a low de jure measure but high de facto capital account openness. And if that is the case, then even though the laws don't allow capital to move in or out of the country, capital is circumventing that law and moving in and out of the country. And so if that is the case, then there will be a contradiction in maintaining both monetary independence as well as exchange rate stability. So therefore, we use the de facto measure, which is based on absolute value of net capital flows into the country. So we don't care whether it's a capital account surplus or a capital account deficit, if we just look at the quantum of net capital flows. Higher is the capital account surplus or capital account deficit, we say that this country is more open to capital flows. If you can also run the same thing with looking at gross flows. And for India, fortunately, these two measures are very highly correlated. So now we have all the three measures of the impossible trinity. We have monetary independence, we have exchange rate stability, and we have capital account openness. So what we do is we resort to something which is called the diamond charts to look at the impossible trinity. So if you look at this graph, then you have 4 vertices. On the top vertex, you have monetary independence, and this goes from 0 to 1. So closer is the monetary independence to 0, it will be, we would say that the country lacks monetary independence. Closer, then on the other vertices, you have exchange rate stability and capital account openness. So for example, if you were to look at a country at the origin, which is right in the middle, then that would be a country which has 0 monetary independence, a completely restricted capital account, and a perfectly floating exchange rate regime. For the 4th vertex, we look at the change in reserves, and there is a reason for this. We look at the change in reserves because sometimes countries have accumulated or decumulated reserves to circumvent this problem of impossible trinity. So we want to see what is the extent to which reserve accumulation has been used to look into this problem of impossible trinity. So if one was to look at the early 1980s, what was happening in the early 1980s, one finds that during this period it was a period of limited capital flows, right? India was a very closed economy at this point. Even trade was not very significantly liberalized. Capital account liberalization was frowned upon. So as a result, we find that capital account index and reserve accumulation index are very close to zero during this period. So since these two were close to zero, especially with the capital account openness index being close to zero, there was no dichotomy between maintaining a monetary independence and exchange rate stability. So you do find that these are relatively higher values of around 0.5, 0.6 for monetary independence and exchange rate stability during this period. Now, if we come to the late 1980s, we find that the pattern starts changing. Towards the late 1980s, we all know that the macroeconomic health of the Indian economy started deteriorating significantly. The current account deficit widened sharply, and there were a number of reasons. One, there was a lot of disturbance in the Middle East, which led to an increase in the price of oil. There was an economic deceleration in some of the India's major export markets, which included the Middle East as well as the erstwhile USSR. And finally, at this point in time, India had started liberalizing partially imports. So greater and greater amount of imports was flowing into the country. So what was happening was the current account deficit was widening sharply. And to finance this deficit, some of the capital controls were relaxed because you needed additional capital. So some portfolio investment started coming in, and there was some amount of borrowings as well as inflows by non-resident Indians. But this we all know. So capital account index increases marginally during this point in time. There is no reserve accumulation, and your MI and ERS are still relatively healthy. But capital account index, though it increases marginally, it's still lower than what we would see happening in some of the recent years. India first confronted this problem of impossible trinity in the period 1993 to 1995. And this was a period in a couple of years after the liberalization had kicked in. And what happened was that there was a rise in the global capital inflow into this country. There was both pull and push factors. The pull factors being that India was a liberalizing economy, so new profit opportunities were coming up, so capital flows started coming in to take an advantage of that, of those opportunities. The push factor was given largely by depressed low interest rate. So at this point in time, India first faced a choice of what to do, whether to give up monetary independence or allow the exchange rate to appreciate. Now, it's very evident what the Indian policymakers chose. They chose extensively to stabilize the exchange rate and let go of monetary independence. So, if one looks at the data, one finds that interestingly, despite this being a period of high capital flows, the rupee to the dollar exchange rate remained fixed for almost more than 2 years at 31.4 from April 1993 to August 1995. And this then leads to, since the exchange rate was virtually fixed, it leads to an exchange rate stability index of 1, which is what is seen in these graphs. So the policymaker, how did it manage to keep the exchange rate fixed? As more and more capital was coming into the country, it needed to be converted to domestic currency to take advantage of this new profit opportunities that were coming up. So to do that, the RBI intervened heavily in the foreign exchange market, and its net foreign assets, if you look at this graph, net foreign assets increased sharply during this period. But this was not associated with a dip in the net domestic assets. So as a result of which, money supply increased and India lost its monetary independence during this period. The situation actually reversed in the second half of 1990s. What happened was this was a period when the global economy started slowing down. There was a series of crises in Latin America, East Asia, and some of the other countries as well. Also, this was a period of economic uncertainty in India. India had undertaken the nuclear tests, and as a result of which a number of sanctions were imposed on India. Similarly, this was a period of political uncertainty as there were several short-lived governments which were there at the center during this period. So as a result of this, there was a downward pressure on the Indian rupee, and what was done was to allow this rupee to depreciate moderately, with the ERS index indicating a relatively low value of ranging between 0.27 to 0.41. So there was moderate depreciation. But this moderate depreciation, which implied greater flexibility of exchange rate as well as the limited volume of capital flows, allowed monetary policy makers to enforce their independence. And as a result, we find that there was an increase in monetary independence, which went up to 0.6 during this period. So one finds that India has been very fine-tuning, has done in a very fine-tuned manner to balance these various objectives whenever it has been confronted with this impossible trinity. The decline in capital flows continued throughout the early 2000s, and it showed signs of revivals only when in 2002-3. Again, the dot-com bubble burst in 2001. There was the September 11 attack, so global economy was kind of depressed. So the exchange rate was again heavily managed throughout this period, and this was done primarily with an objective of maintaining a real effective exchange rate. Now, as we all know, that the real effective exchange rate is made up of the nominal exchange rate as well as inflation. So as inflation in India is higher than some of its trading partners like the United States or the United Kingdom, to maintain a stable real effective exchange rate, you need to compensate for the high inflation with a depreciating currency. So that was what was achieved, but this depreciation was extremely moderate. The current account turned into a surplus in 2001, and capital flow started coming into this country, and this again then led to a problem of capital flow. So the capital account openness index started increasing slowly. However, the government again attempted to sterilize these flows. It initially drew down its holding of government bonds, but soon it started running out of government bonds. And at that point, what it did was to introduce the market stabilization scheme bonds. These bonds, and we know their sole purpose is to sterilize capital flows. These bonds are issued by the government, and then they are sold by the RBI on behalf of the government to the banking sector to suck out liquidity that has come into the system due to intervention. So there was a decline in monetary independence index during this point in time, because despite sterilization, the money supply started increasing in the Indian economy because the sterilization was nowhere near to the quantum of intervention. The policy trade-off actually got worse since 2003, because if you all remember, in 2003-4 onwards, the capital inflow started started pouring into this country. It reached a value of 0.54 in 2006-7 and 1, which is the highest value according to our index in 2007-8. India, what it did, as I was saying, was attempted to achieve an intermediate regime, and it intervened heavily into the foreign exchange market. So there was a sharp accumulation of reserves. If you look at the delta RES, which is our measure of accumulation of reserves, it rose to 0.43 in 2006-7 and 1 in 2007-8. Policymakers rose to sterilization. I've already discussed this, but again, this sterilization was ineffective because the quantum of intervention was much higher than the quantum of sterilization. And also, there is a cost associated with sterilization, because when you are issuing bonds, there is an interest rate cost associated with the sterilization. So RBI couldn't go to the full steam to offset every intervention that it was making through sterilization. So though there was a sharp increase in MSS bonds, it rose up to 1.4 trillion in December 2007. But after that, RBI stopped issuing these kind of bonds because of the interest rate cost associated. Other measures were introduced to control the money supply. These included increasing in the cash reserve ratio. So CRR was increased by 200 or 250 basis points during this period. But these measures didn't help. There were also some measures which tried to curb the foreign capital inflows. If you remember, in 2007, you had restrictions on external commercial borrowings, you had bans on participatory notes, but these really didn't help the issue. So at the end, what happened was the rupee had to be allowed to be appreciated, and it appreciated by 15% between mid-2006 and 2007, which led to the ERS index dropping sharply to 0.44 and 0.36 in 2006-7 and 2007-8. Then we come to the year of the global financial crisis, 2008-9. I mean, we all know that there was a flight to safety of capital. So this year is very interesting because first half of the year you have capital coming into the country, second half of the year you have capital going out of the country. So net capital flows were virtually zero. So capital was coming in and going out of the country, so therefore it didn't pose much of a problem to meet the other policy decisions. Reserves were used to stem the outflow, and one finds that there was a sharp decline in actual holding of reserves. Reserve declined by $30 billion. Actual reserves that were put into use declined by $30 billion. So we have the delta RES index being at around 0.42 during this period. The rupee was allowed to depreciate, and it actually depreciated by 21% if one looks at between March 2008 and March 2009. There was a sharp depreciation of the rupee, and this led to ERS index taking one of its lowest value of 0.27 in 2007-8. So both the decline in capital flows as well as the flexibility of the rupee, it then allowed India to reassert its monetary independence. And this was again gets reflected as the MI index increases to 0.52 during this period. Since April 2009, we are in a period where we have again started receiving capital flows, and the cap open index has again increased sharply. But again, this resurgence in capital flows has led to led to India facing the problem of the trilemma or the impossible trinity, and it has done this by starting to putting some restrictions on capital inflows. The rupee has also been allowed to appreciate, so India has given up to some extent on exchange rate stability. Increasingly, RBI has actually refrained from intervening this time around, and this is because of a couple of reasons. Firstly, the RBI has to manage record borrowings for the government, because the government had to borrow a lot of money to pay for the fiscal stimulus measures that it had undertaken in the wake of the crisis. And any sterilization which is associated with a rise in interest rate would be seen as an additional cost for the government. The sterilization, and as we have seen that in the initial years, the sterilization was incomplete sterilization was associated with intervention, and this led to an increase in money supply, which led to the exacerbation of inflationary pressures, which is really not something that the RBI can afford with such high inflation rate. Also, it was thought that a strong currency would help in moderating inflationary pressure. So now we come to the final topic, which is the policy choices under the impossible trinity. That is how India has undertaken the various policy choices under the impossible trinity. Has India been bounded by the impossible trinity? So what we try and see, we look at the goodness of this regression. It's a very basic regression. What we try and see if this regression where we force the left hand side to be unity is what is the goodness of it as monetary independence, exchange rate stability, and capital account openness. How much do they explain this regression? And what we find is that there is a very high goodness of fit if you look at the adjusted R square, which is in excess of 0.95. So what it tells us is that India has actually been bound by this kind of a impossible trinity framework. Now, if we look at the various individual measures, what we find is an interesting. I mean, this is the three graphs. The first one is for the entire period. In the second one, we assume a structural break in 1991, which is the year of the crisis. And in the last one, we assume that there is a structural break in 1997, which is the year of the Asian crisis. It's very interesting because in the initial years, 1980s, India was characterized by high monetary independence and high exchange rate stability. There was virtually negligible capital coming into the country. But after the 1991 crisis, we find that there has been a dip in monetary independence and a rise in exchange rate stability. But subsequently, from mid-1990s, there has again been a resurgence or reassertion of monetary independence, which has then declined in the early 2000s. And in recent years, that is after the collapse of the Lehman Brothers, we find that monetary independence has really taken off. And this period has also, the recent years have also been associated with a sharp decline in exchange rate stability index, so that has not played a very important role. And again, the recent years have been characterized with a rise in capital flows. So we do find that India has been bound by the impossible trinity. The other way to see what is how India has been bound by this impossible trinity is to look at what has been the sum of these three measures, because ideally these three measures, monetary independence, exchange rate stability, and capital account openness, along with their the parameters or the coefficients, should not exceed 1 or should not be too high, more than 1. Because if it's more than 1, then one can say that, yeah, well, India hasn't been bound by impossible trinity because it has allowed higher monetary independence, higher exchange rate stability, and higher capital account openness. But if we look at this last graph, we do find that in the sum of these three measures have been very close to 1 through most of this period. There was a dip in 91, 92, and this was largely because the rupee had to be devalued significantly, so there was a dip in the exchange rate stability index, and there was a zero amount or almost negligible amount of capital coming into the country. The other dip is what we witnessed in 2003, 4, 5, or 5, 6. During this period, though capital flows were coming into the country, but more monetary independence as well as exchange rate stability was being forsaken. So as a result, we have a dip. So to conclude, what we find that India has adopted a calibrated approach towards the integration with the global market, right? In recent years, there has been a sharp rise in capital flowing into as well as out of the country. And this has exacerbated this problem of impossible Trinity, which is the extent to which you want to have monetary independence and maintain a stable exchange rate. What we find is that India has resorted to multiple instrument approach. As I said, that at one point in time it used serialization, other point in time it used reserves, then it used cash reserve ratio, it allowed the exchange rate to vary. So it has resorted to various approaches, and it has basically juggled capital flows, exchange rate stability, and monetary independence. It hasn't said that I'm going to let go of this one policy tool and just focus on the other two. It has jumped. So at one point in time, monetary independence and exchange rate stability might be important, but then it has used monetary independence with capital flows forsaking exchange rate stability. So it hasn't been very restrictive. And what we find is that this kind of a flexibility has helped India really well. It has allowed India to maintain a healthy growth rate, a targeted monetary and credit growth rate, moderate levels of inflation, and a sustainable current account deficit. So India has really progressed well with this kind of a policy tool. Thank you.
Okay, as we come to from conclusions from your lecture that the capital flow has been good over the years, but and especially in maintaining the economic growth and the other parameters that is required for the ascertaining the economic health of the country. But what about the poor who has become more poorer in last 20 years? So in that case, the role of the capital flow, the capital which came to India has been used for the benefit of the entire India, just for the particular section of the people.
Yes, unfortunately, while India has progressed well and it has been growing at 9% over the past few years, what we find is there has been a sharp increase in the inequality, and that's also evident from some of the recent committee reports that we have, the Tendulkar committee report, where the incidence of poverty still remains high. Now, it's true that capital has come into this country, but what has happened is that the benefits of this capital has not trickled down to the poor. And again, it might seem like a cliche, but again, our domestic policies are to some extent responsible, have to be held responsible for this. Because if it's an FDI that is coming into the country, what has happened is that most of this FDI has been taking place in sectors which are capital intensive. For example, telecommunications, computer and hardware services. These are very capital intensive sectors. So if an FDI, if a firm is set up with FDI, these kind of firms, then what you need is a lot of capital, and what you need is skilled workforce. So you don't require those semi-skilled workforce, which should be the backbone of our country. So I guess to that extent, we haven't been able to attract the right kind of capital into our economy.
So do you think that now is a time when we shift our focus from just gaining the capital, like say extracting money or generating money from the different sources, than to make the people more to take steps which makes the people more happy and more?
Absolutely. I think it's high time that India should just not focus on sustainable growth, but inclusive growth. And well, we have been making the right kind of sounds, because if you look at every year's budget, most of it is tilted towards the poorer people. If you look at this year's budget, there have been a number of measures that have been introduced, whether it's the cash transfer or it's the increase of the income tax slab. Those have been addressed at the lower middle class or the poorer people. But what we find is that there are significant leakages. So what has to happen is we have to stop those leakages. So not only has the government increase its expenditure that is there for these kind of measures, but it has to also ensure the efficiency of these kind of expenditures, which is not happening.
So inclusive growth is also a kind of say only in with terms in a number in one sector. So inclusive development and inclusive growth, what is the difference and how we can go for the inclusive development instead of the inclusive growth?
Right. Here, you're absolutely right. I mean, there's the basic difference between growth and development. That is, growth doesn't have a human face, whereas development has a human face. So I think, there are a number of ways where the government can proceed. But it has to start at the grassroots level. So, for example, you have this huge 40,100 crore rupee institution called the NREGA. So if one was to devote that to ensure that there is sustainable infrastructure, there are good schools that are being created, there are good roads that are being created, then those would help in enforcing not only just growth, but also development by linking the small cities and small villages with more urban centers.
What about your take on the statement which I like to make, which I gather, that India is still in experimental mode? Like, let us start Manrega, let us start this, it will, let us give like loan farmer 60,000 crore, it will help. So this way we do experiment, we don't follow a concrete policy that is going to transform the needs of the people, transforming the life of the people, their lifestyle, and also transforming the entire India in a better way.
I absolutely agree with you that of late in several budgets, I mean, we have been making a lot of noise about introducing newer and schemes with a greater amount of cash outgo without evaluating these schemes. But the problem is, again, that we introduce a certain scheme and then we find that it hasn't worked because of inefficiencies or leakages, and then we think that some other scheme is going to work. But having said that, I think in recent years there have been some positive moves. One of which is this unique identification number, which is where the committee headed by Mr. Nandan Nimkani is being set up. Because I think that will help us to identify each and every individual. Now, once that is done, I mean, then you can think of several ways as to how to target that individual in a better way, whether it's through cash transfer directly or giving him some direct subsidy. But you can at least identify the person you want to deal with, because right now what's happening is that this entire amount is getting lost in the bureaucracy and the corruption that is entailed therein.
Do you as economists feel this is true? Because if we go with the practice of the rural India, everyone was knowing with other person through name, through their caste, through their through their wealth status, what they're having. This is the unidentification is the only problem of the metro cities. A few metro cities which have grown up more in the proportions. So in this case, the telling that this will help in a developmental work, is it fine to say? Maybe it will help to some extent in tackling the terror regime and etc. But that is also true, you can say this is also solid, because one through ascent, through your gate, one can identify the person where he belongs to.
No, that's true. I mean, identification is not an issue for individuals who are living in that area. But I think if you look at it from the Planning Commission or the central government's perspective, then whom to target to give this cash transfer, that is a problem. So there are two ways to do it.
That is already known. Who are the BPL in the villages? Yeah, how many number of BPLs in the block level at district level?
Right. Now, what is happening is that person is not directly getting that money. It's coming through some intermediary, whether it's the Panchayati Raj or the village head or the BDO. And so once you get these series of intermediaries.
So one way you talk about the empowering people to fight for your right. Another way you are empowering the officials that this way you will go.
No, so I think you need to cut this entire set of middlemen that is there and directly deal with the person. And hopefully technology will make us, will help us to do that.
But technology will help us. How this UAN is going to help it?
No,
have a study been done on this level?
No, I think the UIN are just being it's just started, right?
Just started, but before starting a pilot project like such a incurring a huge amount, we need to do some kind of research, and only then we can move on. Because we, as we go through experience, we have a number of cards, and different I-cards. Even if people are not having places where they can keep the I-card safely, like in Kosi deluge, the people having the I-card that has been already washed away.
Right. No, I agree. But my point is that what this UID is doing is that it's at least delinking these set of middlemen. It's allowing the government to directly deal with this person. So, I mean, again, there can be inefficiencies in that sense, but we will have to deal with that.
That will come to later stage.
Yes.
My question is at philosophy level and at thinking levels.
I'm an economist, not a philosopher.
The philosophy of launching this scheme.
No, because I think that you need to have. We tried with the PAN number, but that's only that limited to people who are paying the income tax, right? So at this level, at least you can identify every person with a unique number, and then through this, if you allow through financial inclusion, if you allow them to open a bank account.
Yeah. My question is also here. Whom we identify, they are facing no problem, but whom though we already identified.
No, what is happening is that the government at the center might know that this village has this much amount of BPL people.
Right.
But what's happening is that it's not directly transferring the cash to those people, right? Now, to do that, it has to identify individually those people. A village might have 50% of its population in the BPL category, you know. So the money goes from the government to the state to BDO to Panchayati Raj and then those persons. So at every level there are these leakages, right? The only way that because it's leaving that the identification to the last stage, right? To the BDO, the Panchayati Raj or village head or the village officer, whosoever is there.
But the problem was not of identification, as I guess. Maybe as an economist, you know better than me. The problem was making them aware. One. The second, the vested interest appears.
Making whom aware?
The village people, this much amount you are getting from the centers, you are getting from the states, but this man, BDO or the other officials, they are not facilitating to come to your ends. So the thing was to make them aware. But we are taking to making the identity of who is to be given and who is not to be given. And the second problem is the problem, if identification solves the problem, you see the number of rich men, the number of persons who are paying the income tax, they are maneuvering the system more.
Well, yeah, unfortunately, that is true in any developing countries where you have asymmetric power. That some person will take advantage. I think every country has gone through that in their development phase.
So, as an economist, a group of economists, what are they thinking on this line? Just start one measure and then.
No, I really think because for the idea is that the UID is not for just any government measure, right? It's to identify people. That's my focus. That it's to identify people, and then you can dole out. Okay, this scheme to this person, this scheme to that person. So it's not that it's a measure. I mean, this is a one-time thing. With every person in India having a unique identification number, then can be associated with that number. It might have its inefficiencies. I'm not running away from that fact. But I guess which scheme doesn't. We have tried a lot of other schemes, the farm debt waiver, the voluntary disclosure.
So that's why my question is, what could be the alternative? We are still in experimental stage. We do experiment. When we fail, we go back.
Well, I don't know. I mean, and whether this I would call this farm waiver a failure. I mean, it was a populist scheme.
It was a full failure.
It was a populist scheme. But the question is that then the government cannot just run away from these things, right? It has the ultimate responsibility, because if you then limit it to microfinance and self-help group institutions, you see what is happening in Andhra Pradesh today.
That is a thing of the governments. Now I am talking about the economics of the country, how they are thinking and what they think of the better for the country and what better steps need to be for the welfare of the people.
No. If you are talking of an ideal world,
not ideal world, that could be in sync with the India's need, India's growth, India's prosperity. That is what.
No, my point is
identity is a problem in the America. People from different nationalities visited there, but in India, was it a problem?
No. My point is that the schemes per se, if they were to work in an ideal world, wouldn't have been that bad. The problem is that there are too many inefficiencies and leakages of the system, which is not allowing you these benefits to reach to the. Nobody can dispute whether a farm debt waiver was good or bad for the. If it was all targeted, if every small and marginal farmer was getting a waiver once in his life, it's fantastic, right? But the problem is that they are not. So it's been cornered by the bigger farmers. Similarly, if the facilities that was given to the BPL people, if every BPL person would get that.
But don't you think this is just like your doctorate in economics? you need a job, you need some kind of platform where you can earn money for yourself, for a family, for everyone, but you are given just a kind of bribe that you don't speak anything for a while, and the farm debt waiver was like this. The farmer needed seeds. Farmer
No,
needed
that's why I
something.
said that it was a populist measure. It didn't solve our problem. But what happens is that you cannot deny the fact that the farmer would have got that benefit, the marginal benefit from that scheme, right? Whatever debt, if it was targeted absolutely well, right? If every deserving farmer got that debt waiver, then one shouldn't have a problem because he one time got waved away, and he can then invest that money for seeds or other things. I mean, that would happen in the ideal world, but that hasn't happened, right? It has got cornered by other people. There were significant leakages. The people who were intended to get it did not get it. So my point is that some of these schemes, again, the schemes that are targeted towards BPL, if the targeting was good, then one shouldn't have a problem. They might not be the best schemes, but at least it's welfare increasing. It's not deteriorating anybody's welfare. So, absolutely, you can increase the welfare even more by looking at some of the solutions that you were mentioning. But it's better than not doing anything. That's
No,
my
that is
point.
true. So that is good. That is good on the part of the governance, but a broader consultation, broader understanding, broader sort of program which are needed for the India. As an economist, what you see, what is the prospect, and how it could be developed?
No,
Because we are more prone to talk about the existing project, existing
Right.
schemes.
No, yeah, that's true. I mean, see what happens. India is currently suffering for quite a few deficits. One is the infrastructure deficit, which we all are aware. One is the skill deficit, and then there is the agriculture deficit. So I think the skill and agriculture are the ones which will constrain India's growth in the future, even more than the infrastructure deficit, because a lot of attention has been paid. And infrastructure deficit, you can still get over with foreign capital or something else. So agriculture has been a neglected sector for a long time. So agriculture investment, public and private, has been going down as a percentage of GDP over a large period of time. That's why you get all these instances of farmer suicides. And over this, credit has become a huge problem. The one that I was talking about, the Andhra Pradesh, I mean, we all know what has happened with too many people rushing in to provide credit at very high interest rate loans. So the government has to have a complete revamp of the agricultural policy.
Okay, the last question I would like to ask you. The overemphasis on the GDP, obsession with the GDP of economics is good for the country, or the economics need to develop another sort of.
No, but economists just don't, to come to the defense of my community, economists don't always just look at GDP. We have other measures where we look at inequality, we look at, so if you look at the Human Development Index, GDP is just only one measure. I mean, you have your literacy and inequality also as a measure of index. We have a lot of other, when we look at a country's development, we look at a lot of other things. What is the bottom 10% of the economy getting? What is the rate at which surviving? What amount of food grains are they subsisting on, so on and so forth.
Okay.
So, I mean, GDP is just one number for us.
Okay, so what the other number could be that, apart from this, that could reflect the nation's health, and wealth both?
No, I think to do that, nation's health, you have to look at the bottom 10% or 20% of the society, how good they are doing. If they are doing, then automatically you know that the top 10% are doing very well. If the bottom 10% is doing fairly well.
Okay. So, well, friends, in a today lecture, we come to know what are the capital flow and how it is enriching India, and what the policy have been taken over the years on the part of the government, and that has benefited a lot to maintain the sustainable development of India. And apart from that, also we discuss the general problem that India is facing, and what could be the probable solution, and how we can prosper in a better way. So with this word, we would like to conclude the lecture here, and I would like to thank all of you for watching the lecture. And on your behalf, I thank Dr. Abhijit Sengupta, who enlightened us with with his lectures in such a interactive way, and very forcefully passed his points. So thank you very much.